Okay, let us continue with our strategic management accounting uh, area. And now we will look at Porter's generic strategies. So, sorry for that. Yeah, perfect, no? Isn't it? So, Porter's generic strategies. We have two types of Porter's generic strategies. Okay, we also studied the same at SBL level as well, which is, cost leadership and differentiation. Cost leadership. What does it mean? Being the lowest cost producer. Being lowest cost producer. Differentiation. Making a product perceived to be unique or different from competitors. For example, um, Samsung do produce such cell phones which are foldable and those have stylus pens with them, whereas Apple does not able to do that till now. So it's a unique product in its own sense. And that's the differentiation. And for this, they can charge a premium or a higher price from their customers, right? So after the generic strategy has been selected, the competitive scope will need to be determined. This is the level of focus to which they would employ their chosen strategy. The broad scope is that offering product or services across wide range of segments, price points, or geographical locations. Narrow scope is focusing on offering products or services to a specific market or type of customer. This is often known as niche. Okay. Cost leadership is the characteristic of a firm having the lowest cost structure in the industry. Okay. Cost leadership implies that the product can sell at the lowest price. It does not mean producer must sell at the lowest price, but that the producer is able to do so. Such a policy is known as pile them high, sell them cheap. Okay. Um, Remember that cost leadership can only be achieved when aiming for a large market share. Methods used to achieve this strategy are, well, how to achieve cost leadership? Just a second. How to achieve. Number one, produce enough units to achieve economies of scale. Use the latest technology. Exploit the learning curve. Minimize overhead costs. Get favorable access to sources of supply. So, as far as the differentiation is concerned, differentiation strategy assumes competitive advantage can be achieved through particular characteristics. And what are those characteristics? Breakthrough products, improved products, breakthrough products such as uh, Samsung Fold series, uh, improved products such as microchips, such as Exynos chips used in the Samsung phones, competitive products, for example, Rolls Royce, exploit other activities of the value chain, for example, Tesco, its close IT link with its suppliers through electronic data interchange, right? So Porter assumes that different products will be sold at the higher price than generic differentiated products. And where who are we competing against? Our competitors in the same segment of the market. Where is the source of differentiation that we have to look at? Then how to use in performance management? Use in Performance management. Well, as far as cost leadership is concerned, performance management will focus on monitoring cost per unit of product and ensure that this is capital variance analysis and target costing may be used to assist with this. Okay. Um, as far as differentiation is concerned, performance management will focus on the basis of differentiation. Example, if they achieve by the offering, superior quality, and performance management will focus on overall quality. Then competitive scope would influence the scope of performance measurement as well on the whether they would adopt a broad range of products and segments or within a niche of the market. So far, so good. Now we will look at Boston Consulting Group matrix. Bolson, Boston Consulting Group matrix. This model, which incorporate the concept of the product lifecycle, helps assess existing products and services in terms of their market development potential and potential to generate profit. More importantly, it can also be used to assess the strategic position of SBUs, and in this respect, it is particularly useful to those organizations which operate in a number of different markets. The BCG matrix was designed as an aid to the management. The matrix offers an approach to product portfolio planning. It has two controlling aspects. One is relative market share, meaning relative to the competition, and computed as revenue of strategic business units, revenue of the divided by the revenue of largest competitor. Example: if an SBU generates a revenue of 20 million, the revenue of the SBU's largest competitor is 200 million. The firm relative market share is 10%, right? That is the market growth. So management must consider the position of the product or the SBU on the matrix comparing to competitors within the same market segment. Now, for example, here it is. Two by two quadrants are here. One is here is market share. Here is market growth. So market share, high, low, high, low, right? We have one type is star products. Then we have question mark products. Then we have cash cows, and then we have dogs product. Well, star product. Star products have a good market share in a strong and growing market. That means market share is also high and the market growth is also high, in which the competition have relatively low market share. Since demand is strong and market saturation and oversupply is not an issue, pricing is relatively unhindered and profit margins are good. Also, manufacturing overheads as a portion of total costs are low due to high volumes and economic ease of scales. When the growth potential no longer exists, a pollen star becomes a cash cow. Okay. Then we have question mark. Question mark, also referred to as a problem child, has a low market share. Okay. Uh, they have low market share of a high growing market rate, whereas the market rate the is high. Okay. In order to move a question mark into a star product, a rising star management may need to invest large amounts to develop and advertise the product. This may be risky as success cannot be assured. Many question mark products remain as such while others become tomorrow's dogs. Okay. Then we have cash cows. Cash cows have a high market share. Market share is high. Okay, of a mature market. Market is mature. They should generate significant cash flows. All products eventually become cash cows or dogs. Then we have dogs products. Dog products are that have a low market share and often loss making. Typically, management decide squeezing out at remaining valuable before divestment. Intellectual property and talent. It is important that firms learn from the transition of a unit from other quadrants into dogs to inform future decisions on how to experiment and invest. It is not necessary to retain dogs in a product portfolio. So, as far as use in performance management is concerned, the metrics can be used to identify the potential for a product or business unit. This can be useful in setting targets. Okay, useful and setting targets. For example, revenue growth would not be expected to be high for a cash cow, but it would be for a star. In the case of stars and question marks, the required investment in marketing will be high, but cash cow flow may be low. Firms should focus on managing its investment portfolio, converting question marks into stars, and subsequently cash cows. This is known as a success sequence. So style of performance management required will be different for a four product categories. Okay. Performance management will be required different for four product for four product categories. And the performance measure used should reflect this. For cash cows and dogs, management should focus on cost control. For cash cows and dogs, management should focus on cost control. For stars and question mark, management should focus on revenue growth and market share. So far, so good. Um, limitations of BCG. Well, difficult to determine high and low in particular situation. It assumes that each strategic business units are linked, independent and ignore synergies. Focus on high market growth high market growth can lead to profit potential of declining markets being ignored. The position of dogs is frequently misunderstood as many dogs play a vital role in helping achieve Competitive advantage. For example, dogs may require to complete a product range and provide a credible presence in the market. Dogs may also be retained in order to reduce the threat from competitors. Uh, so far, so good. And I hope you get it till here. And further, we will continue in our next class.